The only school that teaches you about money is the School of Hard Knocks. Until now.
You need to learn this business, and this is the time to do it.
Become an insider, so you have to know the rules before you get in the game.
Welcome to the Money MBA Podcast.
Have I got your attention now?
Where you'll learn how to be a master of money.
There's so many ways to make money today.
Let me show you in 2 seconds flat why the rich get richer and the poor get poorer.
Now here's your host, Jon Kutsmeda.
Well, here it is, everyone. The fourth and final part of my 4-part series with Radigan Carter. Man, what a journey it's been. Thank you so much for sticking with us and coming along for the ride. It was a lot of fun. It was hard to believe how fast time was flying for the two of us. And if you're with me now, I'm sure the time has flown by for you as well. So there's still a lot to cover. We have one more to go. So let's get it started. The fourth and final discussion, or fourth and final part of my 4-part conversation with none other than Radigan Carter.
Well, and the other thing too that I think about is it doesn't get easier the more time that goes by.
No.
So if you don't start now, like it's not going to get easier. And the other thing is like once you dive in, it's just not that scary. And I would even say that, what you're saying about timing and the sunrise, and that at some point you just get to where that's not even like the most important thing in your day. It's like, hey, I got the positions, they're doing what they're supposed to. And, a lot of days, like I don't even bother looking at prices most days.
Agreed. Yeah.
There's just more important. Once you get that figured out, then you kind of start thinking about, okay, how can I apply this same skill set and the same, mantra of personal responsibility to other areas of life to get better at. Because it just, to me, it kind of, like you can't compartmentalize it, right? Once you go down this road, then you just kind of want to start improving every aspect of your life, and it branches out. And that's actually the fun part. There's no end to it.
Yeah. And like you said, the earlier you get into flexing those muscles, and I think it's why I'm hyper bullish on this, what I think will really be the true entrepreneurial wave, because I think people will have to fend for themselves. You're not going to be protected under these corporate entities. There'll be more of this decentralized, localized economies, and people embracing their passions, their hobbies, their skills, and finding a way to mash those things up and actually live a life and develop a career that's relevant to them. I'm speaking probably right now mainly of some millennials, but most of the Zoomer generation. I mean, I'm so excited for anybody who's in that demographic, because as uncertain as the future is, I think that's the blessing that they're basically, evolving into. And the sooner they accept that's most likely the reality, that there's a lot of chaos on the horizon, and the system that their parents, lived in is probably not the system they're going to live in. But they have an opportunity to basically design or write their future more than any other generation, especially when it comes to investing and things like crowdfunding. Maybe, you're not designed to be an entrepreneur. You just don't want to be kicked in the teeth that much. But you can go work for one and whose mission you believe in, and that's part of the journey. The next part of that is how you invest. And for people to be able to, and I think this is a great transition to talk about real estate, for people looking at, what's going on in real estate right now and just real estate in general, if you're going to take your money and invest in what would be traditional, right? Like, okay, if you're going to buy $1 million house today, if you had the capital to do that, do you think not just in 10 years, but in your lifetime, that property is going to 10x, that's going to be worth $10 million? I find that very, very hard, a very hard argument to make, when I think most of the appreciation that you're seeing is currency debasement. So if we enter a new paradigm where money is more sound, do you really see maybe real estate's at certain points no longer priced in dollars, it's priced in Bitcoin or something like that? And so I don't think talking about the asymmetry of things like Dogecoin, I don't think you have the same asymmetry in real estate anymore. It was how your boomer grandfather built wealth. I just don't think it's how the Zoomers are going to generate wealth. And if you have a little bit of money to invest, I don't know what the speculative asset will be then, like cryptocurrencies are today. I don't know what the frontier asset will be.
Yeah.
But I'm pretty confident that when you reduce the barrier to entry and you get rid of this accredited bullshit, if we're talking $5 million today for crowdfunding, in 10 years, why can't that be $50 million? Right. And so if I'm a Zoomer and I'm, now in a decent stage of my career and I've got a little bit of money in it to invest, do I think putting today's numbers and using today's numbers for this example, do I think, $200,000 into $1 million property is a 20% down payment that maybe if you extrapolate backwards and say, okay, it's going to appreciate 4% a year. Is that really how you want to invest when you were born into a massive convexity trade, right? A huge asymmetric world. No, I think you're going to be better off doubling down on someone else who's got an idea and a passion to make it happen, like a Bezos. And if you're going to the same way we kind of invest in crypto today, take $10,000 and invest 1,000 and 10, call it cryptocurrencies, which are really VC tech projects, and hope one of those does a 10,000x. Well, I think it's the same way in the real world. I mean, you can take your $10,000 or your $200,000, and instead of investing it in a home that's a utility, as far as I'm concerned, you could take that and break it up and invest in these startups that before you couldn't because only the VCs could, and it was too risky. And now you can also, I think you start to see entrepreneurs that maybe before didn't feel like they could, pursue their passions and dreams, do that. And so the investment community now has more ideas and more people to get behind. Like whatever your thing is, whether it's saving the world or building flying cars, I don't know what it'll be. And I don't care. It's not the point. The point is whatever your passion, your belief system is, now you can put your money behind it. Instead, what you've actually been doing is letting it rot in a financial system that's designed to make the banks and the money printers rich, while you slowly become more and more dependent on the system because your savings can't keep up with inflation and asset appreciation.
I think the other thing too that I've been thinking about, because I've never owned a home because I've never lived in one place long enough to justify it, I thought. But it is discouraging though, like going overseas, in 2008, and you come back 10 years later and, housing prices, you might be looking at a house for, $250,000 in 2008. And now that thing's $1 million in 2020. Right. And you're thinking, dang, man, like I wasn't able to 300%, the investments over that time frame. But with what you're saying about the currency debasement, I think too, who do you think, if you buy $1 million home now, mm-hmm. and you think that that's going to 10x, who's going to be buying that from you?
Exactly.
Like you already have, most couples are already dual income. If you have a house in the suburbs that's designed for a single family home, well, most couples are already dual income. So you've already maxed out the potential for increase in money in the household. I think it's a pretty safe assumption to assume property taxes are only going higher.
Yep. I would agree.
So taxes are going higher. And, regardless of what interest rates do, I think it's kind of could you see negative interest rates? Yeah, maybe. But you know what? The Fed might raise it too. Like we don't really have any idea what they're going to do. But point being is that if taxes go up, Well, people don't buy homes based on like how much that home costs. They buy homes based on how much can they pay on their monthly mortgage. And if taxes go up, then the payment that they can make on that mortgage is going to go down each month. So I think that would have a negative impact on the price of a home, or at least on the pool of buyers that are going to be buying that house. So kind of to your point about, is a $1 million home going to 10 million? I doubt it. But the other thing is I don't think the people that would be looking at your home now are going to be looking at it in 10 years. They're not going to have the income to do it. But it's just, I don't know. I mean, even the size of the houses, I was, and this might be because I lived in a metal box for so many years. Like when I look at the size of the houses that are being built, I mean, do you really want to pay for a remodel in 5 years with the cost of materials and what they are? Do you really want to pay to remodel 4,000 square feet? Like it's pretty intense, really. I just don't. So I don't know. Like I wish housing was more affordable, but I'm kind of I'm definitely in your boat that when I look at that, I can't see sinking money into it.
Yeah, I mean, I'll probably get the saying a little wrong here, but what is it? We make emotional decisions and try to justify or rationalize it with logic. I don't think there's a better example of that than real estate. And I would say almost every client I've ever worked with, if not every client, the purchase of real estate has been purely emotionally driven. And one of my favorite sayings is you never ask a barber if you need a haircut. And I feel like they already want a haircut, so they go and ask the barber if they need one. They're so emotional about the idea of owning a home that they go and ask someone who's financially incentivized for them to make that decision, i.e. a realtor or a loan originator. Is this a good idea? Should I do it? And, if you own a home and you ask, a real estate agent if it's a good time to sell, they're going to tell you yes. If you don't, and you ask them if it's a good time to buy, they're going to tell you yes. And so this also goes in with some of the other conversations we talked about. You brought up Boeing. I think overall society's incentive structures are completely broken. And, the roles that people are playing in the real estate transactional business, everybody's a profit seeker, and they're preying, they're parasites on this emotional. It's both a financial decision, but one that's also very emotional because of maybe they want to raise a family, stability. But then this whole real estate only goes up, and just this idea that it's as sure as houses, and it starts to play on their mind like this is a good financial decision. And there's some interesting, I'll send you after the call, there's some interesting data out there. One of those pieces I reference a lot is called the Herrengroth Index. And this goes back like 500 years. And one of my first podcasts I did with an Aussie guy, he runs a podcast called the Jolly Swagman podcast. And really, really smart young man, very academic, very, very brilliant. He did this whole thing because Australia is basically like the poster child of like a housing bubble market, and it's
like 50 years or something crazy.
It's just silly, and but it also goes back to a lot of the things we've talked about, where it's like it's a directional based bet, right? Like for everyone who's like the bubble's going to pop, you took the one directional bet against it and you've gotten run over, right? Yeah. So he did this whole piece on it was called the Housing Bubble Week. And he really went deep. And like I said, his podcast is exceptional in terms of the research he does. sometimes it's almost like too intellectual.
Mm-hmm.
But I give him a lot of credit for how much hard work he puts in. But he did this exceptional series on housing, and it was really centered around Australia, but it was across the board. So anyways, long story short, he's how I came across this Herrengrach index, and he does a whole interview on this. So this is in Amsterdam. It's this area that's always kind of been a quality area for 500 years. Long story short, what the index shows is that home prices, when adjusted for inflation, are flat. And so what you're really owning is this apparent hedge against inflation. And so you're at that point really back to just basically making an emotional decision. And so a lot of things I've written about and try to explain to people is you're either renting the money, right? You're either going out and you're getting a mortgage and you're paying interest on that. So you're renting the money, or you're going to rent the property. You're going to be a tenant. Either way, in theory, that is money that's getting pissed away to nothing. So the argument then becomes, well, if you own, then you get to participate in the appreciation. Well, there's no guarantee that there's going to be appreciation, so it's speculation. But I'll give you, the benefit of the doubt that for how long appreciation has been the linear path, not linear, but the direction of things. But when you really look at it, one of the things I often tell people is, so you own a house in XYZ neighborhood, and you think you've got all this equity, right? And you've got some sort of advantage because you bought early and it's worth more. Go ahead and sell your house and try to buy another one in the same neighborhood. So you haven't achieved anything, right? You're keeping up with the pace of inflation or keeping up with the Joneses. Now, it makes sense if you can arbitrage that. If you're in a high appreciating area where it's a high dollar amount, like say you buy in Hawaii and across the country, markets appreciated 10%, but you didn't buy a $200,000 home, you bought a $600,000 home. So in the nominal terms, in dollar terms, you've gained more dollars. So if you leave a high price market like that and go buy in Albuquerque or wherever, you're going to be able to buy a lot more home with the dollars that you've gained, but that's an arbitrage. And if you want to play arbitrage, I can show you a lot of ways that are highly more efficient, less expense, less tax, less all of that. So this idea that you're going to buy a house that's going to be worth more in the future, what you're really doing is you're just keeping up with inflation. Now, I'm not against real estate as an investment class. What we're talking about here is people buying a house to live in. And so yep. I'm just very adamant with people, like when you go and buy a primary residence, this is Kiyosaki 101, right? You're not buying an asset, you're buying a liability. And so if you really want to get ahead in this game, you want to prosper and you think real estate is the vessel, then you need to be buying investment properties. And you need to make sure that those things are netting a positive cash flow. And if you're finding it difficult to do that in one market, then go to where you can. Invest where it makes sense. Live where you want to live. Rent, live a lifestyle in an environment, in a neighborhood, in a state, wherever that you want to be in, but put your money to work where it makes sense. You're not going to buy a stock that's plummeting and has no hope of ever recovering. So why buy a piece of real estate in a property market that you're never going to cash flow in and you're never going to realize a good, NOI on? And then multiply that process. And then if you really want to add leverage to it, or what ultimately could be considered leverage, then you get into things like vacation rental, and maybe you double or triple that cash flow, because now it's no longer just this passive income stream. What you're really doing is running it like a business, which is also something that people need to realize. The beauty of real estate for so many people is you kind of set it and forget it. Once you get a good tenant and you bought at the right price and it's positive cash flow, you can count on that income like it's a bond. So overall, that's, when I'm looking at real estate, I don't care what the market is doing in general. That's kind of the philosophy I try to, introduce people to. And when you look at the historic data, when people try to say like, oh, but real estate's up 10%, I'm like, yeah, well, maybe it's the dollar's down 10%. You look at everything is up. Milk is up, lumber is up, stocks are up. So are you really participating in the best way to, illustrate that theme of inflation or currency debasement? I don't really think real estate's the answer for most people, especially when you think about how much you've got to sink in to participate in that, when you've got things like cryptocurrencies that are going bonkers. And I think you've got a future economy of entrepreneurs and crowdfunding and mini VC participation that you can really generate an incredible return on.
And so that's a good point, because, and I might be, pretty old school in my approach to this, but I've always thought that, for a place to live, right?
Mm-hmm.
I've always rented because at least that way I had a fixed cost every month for my living situation. So I knew, that, hey, this was a fixed cost every month. There wasn't really any fluctuation in it. And for people that bought a home to live in, I never understood, if you were buying a home, I always thought, hey, why don't you just want to pay that off? That way you can reduce your living expense to zero. And this has been my main issue with what, monetary policy has done to housing, is after 2008, with the cost of housing going up, and, there's several different factors, but when you have hedge funds that are now buying entire subdivisions and out competing, first-time home buyers, like, that's not right. Is that really what we want to be doing as a society? And because you're actually, in a way, you're denying someone the opportunity to buy a reasonably priced home for them to live in, reduce their operating costs, their fixed costs, to almost zero every month, and then they can actually start building wealth if they wanted to. But because I don't think most people that are buying single family homes as a place to live in, I seriously doubt most people buying $1 million house or even bothering trying to pay that thing off.
Well,
maybe I'm wrong.
Yeah, so that would be
I don't think they are.
Yeah, that would be my pushback to that, because, having a decade of experience looking into the average person's personal finances, they don't do a very good job of managing their money. And I've been the benefactor of that, because most people are constantly doing something with their property because it's their main piece of collateral. So they're always refinancing and doing something or other. So it's worked well for me because I manage my book of business, my clients, as a fiduciary and not as a salesperson. So knowing them better than they know themselves, partly out of experience, but also understanding human nature and how people typically behave with debt, I've been able to kind of help them avoid their own demise in a lot of ways, knowing, like, the number of times people say they want to do XYZ with their mortgage because they're going to pay it off in XYZ time. It's just comedy to hear that, because people can't even make plans a month out, a year out, and they're making these like grandioso 10 to 30 year decisions. And it's like, dude, you can't even tie your shoes. Like, so let's scale this back a little bit and be more realistic, and try to make what I try to do with my clients' mortgages is make more or less 6 to 12 month decisions. And that also gives me, that's about my comfort level in predicting. I say that very delicately, but having a level of conviction as to where I think interest rates in the bond market are going to go. So yeah, you can have some major blowout, but I think the more attention you pay to the macro environment, and certainly what central banks keep telling you their monetary policy is going to be, you might see inflation in a lot of different places. I don't think you're going to see it in the bond market. Now, certainly that means price discovery is dead. And I don't want to own a 1% government bond, but do I think we're all going to turn Japanese? And so is that going to happen in 2, 3, 4, 5 years? I don't know, but making these 6 month decisions there's a certain risk that comes with that. I explain that to my clients, but that's, I think, a window of time that I have comfort and conviction in helping people navigate these credit decisions, because literally it only takes for most people 6 months before they screw it up. And they're like, yeah, I was going to do this, but I ended up, remodeling my house and I didn't pay off the debt. And now, it was a teaser loan and now it's 20%. I need to refi again. So some of which the financial engineering that central banks have done, and certainly the QE that's supported the mortgage-backed securities market, I think a lot of people, this isn't necessarily about, in my opinion, inflating asset prices. We're a credit-based system. If credit doesn't continually flow through the economy, we've got a big, big problem. And maybe to their credit, and maybe they just got lucky, but I think the central planners were very aware of what the average consumer's only asset and piece of collateral was. And in order to continue having credit flow through the system, they got to be able to continue to lever it. And the only way you can continue to lever a piece of property is if you keep getting more and more equity, which again is another way of illustrating the debasement in the currency. But so to take a step back, I feel like what BlackRock and the rest of these are doing, these big hedge funds and even boutique hedge funds buying up huge tranches of land. Yeah, I mean, you're creating various types of oligarchs. These,
Yep.
it's early stages of serfdom. So do you try to compete head on with that by claiming your little block of land, or do you play a different game and try to generate wealth in other areas so that if you actually want to own, a castle with acreage, you built your wealth someplace else? So I think, when we talk throughout this conversation about the game and the rules changing, real estate's just not how you're going to win the game. And it's very interesting for me to say this, and I've been saying this for a decade because this is how I make my living. And when you talk about trust, it really resonates with me because people have trusted me for a very long time because I've always been very honest about, the barber coming. I'm the barber and they come to me asking for a haircut and I tell them, no, man, you're good. You don't need a trim. Right. And so that really develops a deep rapport. And I've been able to do very unusual things in terms of mortgage strategy and real estate strategy with people that I think 99% of my industry couldn't even dream of doing because they don't have the trust or rapport and they're just profit seeking all the time, trying to close, trying to push, trying to close. Everything's a, Glengarry, Glen Ross, ABC and situation, always be closing. And I think people need to start acting as fiduciaries again. And I think that's also part of this potential sea change in the economy where you can be more responsible as a fiduciary when you're not competing with 100 other people who are just out hustling you because they're a better salesperson. And you're not getting sucked into this like hustle because you actually demand value because you're doing something special and unique. And I think that's a benefit to society. As part of that disruption and consolidation, I think you get higher quality product. And right now, when it comes to financial advice, especially in real estate and mortgage, the product is very piss poor quality because the incentive structure is wrong.
Well, and I even think it even speaks to something larger than that. I mean, you're taking on responsibility to fix what you don't like about the system. I mean, because at the end of the day, that's it, right? If there's things about the system you don't like, then we all have a personal responsibility to basically not be participating in those aspects that we don't like about it in our own lives. And I think that speaks to, what you're saying about the fiduciary. I mean, I'm a big fan of Anthony Deaton. And, one of the things that he says is there's a bear market in prudent men. And, I think that's very true. And that's how you stand out with the trust. that's interesting about the real estate. I kind of, because when I started really taking a deep dive into finances, um, the thing that I kind of keep coming back to with monetary policy, or what we're being encouraged into going into for asset classes, and maybe I've just been looking at all of it too long, but in a way it's all starting to feel just kind of like the same trade.
Mm.
It's almost like, and I think I understand pretty well why they've made the decisions they've made, because what you were saying was an excellent point about, hey, if someone's house is the largest part of their equity and it's a credit-based system, then you got to do whatever you can to keep that on life support so the system can continue. But you can only put so many Band-Aids on gunshot wounds before that doesn't work.
Right.
And it almost, in a way, like it almost feels like they've just kind of consolidated the risk to where these asset classes that should typically maybe behave a little bit differently are not. And they're all kind of behaving similarly. And to the point to where if I wasn't in crypto, I really don't know where I would put my money into other asset classes, like substantially, to try to get a decent risk reward where I felt like I could take a small risk for a decent setup. It's not, and maybe that's my own mistake, but like when you look at the work that Mike Green's done on passive investing, right? Like can you imagine what's going to happen on the next bear market with everyone in the same passive vehicles and the housing market at the same time? And heaven forbid they actually raise rates instead of lower rates. And that's not unprecedented. I went back and looked at charts in the 1970s, the 10-year charts in the 1970s during some of those higher inflation periods. And the Fed actually raised rates. And I mean, people took a bath on their equities and bond positions because they moved down together. So I think there's a lot of hidden risks there that people really aren't aware of when they say, hey, we're just buying these asset classes because they've worked for the last 40 years and this has worked great.
Well, like you said, there's how many people in their 30s that have never seen a bear market. And I think some of the stuff that Mike Green has done, I mean, there's so many good interviews he's done, but some of the work he's done on passive, it's a lot for the average person to chew on if this isn't their thing, right? And if I was going to digest his ideas and regurgitate to somebody in one sentence, it's kind of like what you were just talking about, which is we've gotten to the point where the next time there's a catastrophic event, and we saw this in March, there is no diversification. Correlation goes to 1. And that's it. That's how I would sum it up. And maybe because I've digested so much of Mike Green's stuff, that has it's a very profound, like, whoa. And maybe for the average person, it's still Latin to them, but I think that's the reality. And when you talk about, where can you get really upside return? I think that's a big point that I'm making in terms of this. Besides, because I'm trying to find a way to have optimism for the future when people ask me that question, because they don't have my risk profile, right? I can YOLO and be a degenerate in crypto and buy Doge when it's 2/10 of a freaking penny, but the average person can't even, they can't conceptualize that, let alone put money into it. And even if I was managing money, I wouldn't. It's a different risk profile, right? Like you're saying, protecting, your team and your soldiers, and there's a widow on the other side, right? There's a family on the other side of that. I'm not going to YOLO into Dogecoin. But still crypto in a lot of ways is a place where you can, realize that type of potential. And I think when I get excited about entrepreneurs, partly it's people taking responsibility and for their futures as well as pursuing their passions. But I think it also creates an ecosystem where people can start investing in things, most importantly, that they understand. And I think that's like, finance doesn't need to be this complicated. It doesn't need to be Mike Green level complicated. I wouldn't be where I am financially if that was the only way you had to play the game, was you needed to be a freaking quant, right? Like, and I just think it's gotten so convoluted and so skewed that direction that most people feel like they can't participate anymore. So, on one angle, crypto is great, but it's also the other side of that pendulum, where it's like, yeah, it's not the Wall Street financial markets, but it's just as complex and almost esoteric to most people, where I feel like the opportunity to invest in someone and their idea that they can sell to you on a 15-slide deck, that I think that's really a revolution that we haven't really embraced yet. And that hasn't happened because of regulation. And Crowd CF, which was just stretched to this 5 million limit this year in January, you want to talk about being early. That's something we're really, really early on. And so you think of all the people that in maybe your small circle that maybe have a particular talent or skill set. Maybe someone makes really badass spaghetti sauce, right? My mom's got the best gravy ever. You know what I mean? But turning that into a business, who's to say it can't be the next Ragu or, Paul Newman's? Like, those are the types of things that before we couldn't invest in. You just couldn't. And if you could, is because you knew them directly, and they certainly didn't have the platform to go out there to a broader community and say, hey, I have this great idea. Do you want to participate and come along for the ride? And so that's one of those things where I think, in all these sea changes and paradigm shifts we're talking about, for me, that's the optimism I have, because it does feel like things are rigged to the point where correlations in a down market are going to go to 1 and people are going to get really, really hurt. And if that doesn't happen, you're really investing in a carcass of an economy, and nature abhors a vacuum. And I think you'll eventually have financial entropy, which you already have, which is why so much liquidity seems to be chasing crypto, because it's entropic, it's chaotic, and you suppress volatility for so long, the markets are going to seek it out. And so even if we literally turn Japanese and we're in this non-volatile world in one sector of the financial markets, I think capital and human beings find a way to create chaos. And this is such a theme of our conversation. If you aren't someone who's embracing that chaos, you're going to miss the ride.
I think one of the most important things that, and I say this as someone that this isn't easy for, but I think one of the most important things people can do is get comfortable with failure and realizing that it's not the end of the world. It's almost kind of like engineering your own survival bias, right? When you only need one yes, does it really matter how many no's you get first?
Right. You
just need one yes. Nothing's 100%. So just kind of keep going and figuring things out till you get a yes. But your point about the next ragu and the sauce. I kind of think because Anthony Deaton's style of, and he doesn't even call it investing. He calls it purchasing participation in businesses. I actually think I think crypto and that style of investing are actually very complementary, even though probably most people wouldn't think of it at first. Because, on one side, investing in real businesses, that the financialization of the system and the gaming of the system doesn't really help you in a real business.
Right.
And whereas on crypto, essentially crypto is removing the financialization of the system of the last, 40 years, right? So I've called it, I'm trying to take a rocket ship to catch the bus to Milano. Because, Anthony Deaton's, one of the things he talks about is he's like, hey, I'm responsible for the people that are invested with me and my passengers on the bus. And it's my responsibility to get them there safely. And, when you kind of, if you were in positions like us to where you had to make your own money and you're in a low interest rate environment, essentially you need a catalyst to be able to build up enough capital to get on that bus. And I kind of see crypto as that catalyst, really. And that's where I think that, I'm going to say the older generation, that they look at crypto and they say, hey, you guys are being irresponsible. You need to grow up, get a haircut, get a real job, whatever the case is, right? I don't think they fully understand that. I seriously doubt a lot of us are just going to stay in the matrix or stay in crypto forever and not buy real assets. We do want to buy real assets. We do want to participate and make real things and help people that have that vision, that are doing those things, because that's kind of the entire point behind all this. So I don't, but I don't see too many people talking about that, which is what you were discussing. But I really do think that crypto and just leveling the playing field is really going to help with, real businesses emerging again. And I actually think that the definancialization of the system is actually a very good thing for everybody.
I totally agree. I mean, look, there's going to be gambling degenerates that are permanently gambling degenerates. But I think there's a real asymmetric risk opportunity with crypto. And to your point, if things go the current path that they're going, even if they didn't go any further, I have a lot more, we'll call play money than I did before investing in crypto. So to take those gains, and where do I go next? Let's say crypto just always performs well for an extended period of time, maybe the next decade. I'm probably not going to keep doubling down on super high risk opportunities. And you will probably start to see most of the things that feel low volatility in the crypto space are going to eke out very low returns the same way real estate has for so long. And so where you're going to have to go find volatility. And the volatility is going to be, at least my belief at this point, is going to be what we're talking about right now, which is investing in real businesses and entrepreneurs, and everybody kind of acting like a VC. That's really what we are anyways. When you go buy Coinbase, right? What you're really doing is you're investing in that company, but things have become so blurry that what you're really doing is just betting on a horse, right? People aren't looking under the hood anymore. They're just like, oh, I like the name of that horse. I'm gonna bet on that one, and I'm just really here for the fancy hats and the cocktails. That's why I'm at Preakness, right? It feels a bit like that already in terms of how people invest in the equity markets. But the reality is, what you're actually doing is just writing a check to the people who are early. So why not be an early participant in a business that, and again, I go back to this intellectual edge that currently puts most people at a massive disadvantage. I don't really buy stocks because I know I'm at a disadvantage for most people who that's their prime focus, right? You want to do some real estate and mortgage arbitrage, dude, you're not going to outsmart me in that game, right? I'm not going to go up against some of the people who've made a career, whether they're momentum or value guys, because it's just, I'm probably going to lose. So why not be involved in something that, in terms of real life businesses, that you personally understand naturally, because you've spent, maybe there's a woodworker in I have a friend from college, he just started a woodworking business, and he's kind of been on a wild journey, and like most of us have, right? Like he came out of college and didn't know what he wanted to do and went kind of a up and down path and different careers and shit like that. And dude, he's doing what he's doing now with his hands, with his craft, with his skill set, working with wood and doing these amazing like finished pieces. I think that's incredible. Now, that's a passion of his, a hobby of his that he's turned into a business. Is it scalable? Maybe, maybe not. But what if there's some sort of manufacturing firm that's created some fancy technology for cutting wood a certain way? Like, he's going to know that business has real impact and real value organically. He's not going to sit there and have to watch YouTube videos and a bunch of other dumb shit to figure out if that's a good investment or not. And I think that's kind of where, when we talk about leveling the playing field, that's how I feel about it. I feel like people can start to put their money in things that they believe in and understand, versus this casino, this circus that they're so disadvantaged. I mean, they're the sitting ducks, and crypto in a lot of ways is similar to that, but it's a new guard. The leaderboard has been wiped clean, and there's new people on the leaderboard, but you're still playing with pros in most cases when you're an amateur. But again, the asymmetric upside is certainly there, and I think will be there for some time. One thing I wanted to mention too about real estate and get your thoughts on, especially considering how you've kind of been all over the place. One of the things I see with most of my clients are military, whether active duty or veterans. And I really empathize with this idea, especially for the active duty who get deployed and they leave family and loved ones wherever, wherever their home base is, wherever they PCS. And this idea of like buying a home creates a sense of stability when there's so much instability. But I see more and more, especially the past 10 years, that being preyed upon. Like, how many people in the real estate and mortgage space are like, military relocation specialist or like VA. You don't really give a shit. Yeah. It's just an easy way to make a buck. And so I kind of empathize with that thought or that feeling, because you guys are going through some serious shit. And the last thing you need to worry about is whether or not your kid or your wife or your significant other, has to worry about things like the roof over their head. So I get that to a certain extent. I still push back on that because I think there's better ways that they can invest their money, and maybe we can talk about that. But the thing I wanted to ask you is what was so interesting to me about this real estate boom that we're having right now. Partly it's a supply thing, moratoriums and foreclosures and evictions. But a big part of the narrative is that you've had this migration or exodus. The millennials finally left the urban environment and flocked to the suburbs to buy houses. Whether that narrative is true or not, my question is, or my point that I'd like you to get your feedback on, what I find really ironic about that is the thing that kind of saved them, that really put them in a better place during a really hard year, was optionality. Right? The fact that they could say, I'm out of here, Manhattan, or I'm out of here, San Francisco, because they were renters. They didn't have the obligation. Or if they chose to stuck around, now they had negotiating power, which is really part of having optionality. Mm-hmm. And in an instant, the thing that gave them the most value, they completely ignored and chucked aside and jumped into an asset that has a lifelong obligation, 30-year mortgage. It is fixed and sticks them in a particular environment where they no longer have the optionality, depending on what type of chaos comes with that. It could be job placement, job migration, all these different types of things. Now they're officially exposed to those types of market circumstances, and they no longer have optionality. And in addition to that, the other point you made about paying your mortgage down to zero and having this no expense. I mean, the reality is you always have maintenance, taxes, and insurance. Yep. So, for someone like you who's kind of kicking around this idea of adding real estate to your investment process or portfolio, and certainly someone who's lived overseas and experienced some of that, I just like your feedback on that idea of people giving up that optionality and some of the emotional elements to that, and how you're looking at that now as someone who's potentially buying.
I think so the option, it's interesting you mentioned that. So the optionality has probably 100% um, assisted me with my ability to earn the money that I have and had the opportunities that I had in life. Because my key thing after I graduated, with my degree is I was going to go wherever I had to make the most amount of money. And so, so part of that is just having the optionality to where, job came up in the Middle East, I went, a few years there, went to another job, and I think I even just rented a furnished apartment for that year. And then, year after that, went and did something else. But at the same time, like having that, you do that for enough years with that optionality, and
Mm.
that very much helped me and set me on the path that I am today. But I think there's also an element of, you miss what you've never had.
Mm.
So, a good friend of mine, like we laugh about it because he says, "Hey, you're the only guy I know that has a greater kudu in his closet." And the reason, so I have like African game trophies like boxed up in my closet. And the reason they're in there is I tell them like, "Hey man, do you know how hard it is to find tall ceilings when you're a renter?
Right, right,
Like I
right.
can't, like I'm trying to find an apartment to rent and I'm just like, oh, the ceilings aren't tall enough for my African game trophies." So, so, and I know that sounds, people are watching this like, hey, this is insane. But, so there's an element to that of, when you don't have it, you kind of start thinking, you know what, it'd be kind of nice to have my own tall ceilings to where I could put the not so clever kudu up on the fireplace, and, and I think that'll come at some point but the other thing too that because I go back and forth, right? There's a part of me that would love to have my own place and to have just to try that stability on for size. But then I also kind of know myself well enough to where probably in a couple of years I'd be ready to go someplace else or try
Mm.
something new. And so I understand why, they left the city and then took on that obligation. But, to your point about housing maintenance and all the things that they used to just be able to send a text and have someone take care of. Hey, I hope you like going to Home Depot. You're now going to Home Depot to buy
Right.
toilet seals, for the downstairs bathroom. You're going to have to watch a YouTube video on how to install that. And, so I think we'll see how many people say, hey, this was fun. I tried it. Home ownership isn't for me. I'm going back to renting. And how many people keep at it. But, what I was always taught was if you were going to be in a place for, say 5 to 10 years, yeah, you could look at buying and you might do okay with it. But my goodness, like I've never lived anywhere for 10 years since I've been an adult. So I think, like I do want to have real estate exposure to my investments in the future. But
Mm.
what I've been looking at that is I don't want to view my home as an investment. If I do buy a place, and the reason I would buy a place is because I can reduce that expense down to zero, except for taxes and maintenance, right? To kind of lower that fixed monthly cost, and because I like the area and like, hey, this is where I'm gonna be. But for my investments, is I would probably be looking at doing being an LP on a firm that I trusted that had the general partners that had significant exposure into those vehicles as well. But after this last year and seeing how like landlords and multifamily properties were treated while with the rent moratorium, one thing that I had a hard time understanding was how those mortgage-backed securities kept getting paid. Because if landlords weren't you can have a rent moratorium. Great. People don't have to pay their rent. But I know for a fact that there was a lot of people that owned property that had renters in there that they didn't get any money for that real estate for, 9 months or more. So I don't know if I honestly don't know if I would be looking at doing like multifamily in the U.S. I haven't read too deeply on it, but I saw the president was talking about removing the 1031 exchange as well, which would, how much foreign capital is in the U.S. housing market that might come out if we lose a 1031 exchange. I think they would possibly go and invest in other real estate markets. I also find it interesting how different like the European real estate market is to the US market, because I don't think they do 30-year mortgages or the long-term debt that the US does. And, something that I find interesting is like you can have real estate exposure overseas. And, Tiho Barakan on Twitter is one of the guys I was reading that does this. Is he does mezzanine debt. So you can have debt exposure to real estate and have exposure to the real estate sector and the benefits that provides without actually owning the property or managing it, because you're providing a level of debt past the senior debt for that project to actually get going, which I don't think really exists too much in the US, but I think that's kind of a design for overseas markets. But sorry for the long-winded response, but I think I do want to have real estate exposure, but whether that's domestic or overseas or how that's structured, I haven't decided yet. But it would be as an LP, like it wouldn't be as me trying to take that on and learn a completely new sector that I have no experience in.
Well, let's be honest. Why I kind of grinned and chuckled at one point when you first mentioned being an LP, I was like, you're going to buy an NFT at some real estate syndicate. I mean, let's be honest as to where this is ultimately going to end up going in the next 24 months. But yeah, I mean, there's a lot in that asset class that I think needs to be figured out post-COVID. And so I wrote a lot about this just within my client email list during the financial crisis, because one of the most heavily impacted was the bond market. And I say that because I think it did things it had never done before, like the 10-year treasury was trading like penny stocks. I thought it was game over because of what I saw happen in the mortgage-backed securities market, which it had never done. And so when I look at where we are now in real estate and the frenzy, this goes back to, I feel like, just such a lack of education on the system, because it's more Ponzi finance. And what ended up happening in the midst of the lockdowns, and then they came out with this, Congress came out with the forbearance. But they rushed the forbearance without really understanding the ramifications it would have on the financial system. And it literally imploded the mortgage-backed security bond market. To your point, like how does that work? Well, there's lots of different types of securities, but speaking of the main agency, Fannie Mae, Ginnie Mae especially, you as a loan servicer, which is the entity that everybody makes their mortgage payment to, who they think owns their mortgage, they're just an intermediary. They're just servicing your loan, and they're scraping off some of the cream off the top. They're clipping a coupon and sending the rest to the bond investors. That's who's on the hook. So they are, when they're securitizing and providing a Ginnie Mae bond to the marketplace or Ginnie Mae security, they owe those bondholders regardless of whether they collect payment from the borrower. So when shit hit the fan, you saw the mortgage-backed securities market implode because the entities, the intermediaries that are really providing that intermediary liquidity, the servicers, because they're buying the loans from guys like me, a direct mortgage bank, and I'm taking loans from brokers because they need a financier like me. And so you have this like assembly line of events, and these Quicken Loan type companies and the Wells Fargos who, they're a bank, but they're heavily involved in mortgages. They're taking these loans, packaging them up and selling them off. Well, now there's no bid, right? And it's not so much coming from the bond market. The Fed can do all they want to support the bond market. It's the in-between guy that's going to drown, because why would they do more loans, turn around and sell those loans to a bond market that's guaranteed a payment stream, and now double guaranteed because the Fed's, basically the one buying those bonds. So you're in bed with the perfect buyer. Why is an entity, a servicer, going to do that when all that does is put them on the hook for more loans that aren't going to pay because there's a government moratorium and forbearance? And so being in the midst of that, why that was going on, hypothetically speaking, there was moments where I was like in the corner sucking my thumb, how is this thing going to, this is the end game. What went on behind the scenes, I don't think we'll ever really know, but I'm telling you right now, it's more than the 5 trillion QE that you saw on the Fed's balance sheet. Go ahead. Yeah. And there's definitely behind closed doors meetings, like Big Shorts type stuff, where these entities were bailed out and provided liquidity to keep some of that going. And that's why by the time June hit, you saw interest rates on mortgages plummet to, these low 2% rates. It had nothing to do with, it was all this artificially stimulated and created. They basically got the defibrillator and brought the market back to life, not just by supporting the bond market, which is now what they're doing primarily, but there was some behind the door stuff where these entities had to be provided liquidity because otherwise they were going to go bust. Because you had, 3/4 of the country stop making their mortgage payment for at least a month or two. And so you can imagine what that does on cash flows, when how much liquidity did they actually have in reserve to pay bondholders who were guaranteed. So a little bit of background on you asked the $5 trillion question that I think in a lot of ways is still unanswered, and people kind of just look the other way, like, oh, here we go, interest rates are low, let's buy a house. And I'm like, man, you really don't understand like how we got here. And that makes me even less comfortable. For all the other reasons we talked about real estate, it makes me even less comfortable because I feel like the house of cards is even more unstable than it was before.
Well, and so that's really good to know, because I literally through 2020, I was sitting here just scratching my head saying, this makes no sense. Like, okay, hey, people aren't paying the rent. You're giving rent moratoriums. Like, someone still has to pay that bond security. And it was like no one even talked about it.
Right. Everyone just YOLO'd into the market, which I right. Yeah, which I mean, look, there's a lot of people who are like, this was obviously the bottom, right? My friend Cuppy, I love how he how well he articulates the idea of jumping into the market when there's blood in the streets. For me, though, I just never felt comfortable in the bottom of March. Like, I get, like, when the Fed says, they're all in, you get behind the Fed. But being at least for me, as close as I was to the bond market and the mortgage-backed securities market, and seeing how broken it was, the last thing I was going to do was going to jump in. And I guess that's a skill set you develop, right? Being able to pull up your big boy pants and get in there in those environments. But that was beyond just like the market having a crash because of some glitch. Like, we were obviously at the start of a global health crisis, and the biggest and what should be most liquid marketplace was literally seized. So I ran to the bank and pulled, 40 grand out in cash.
Oh, I went and bought a freezer and it stocked food. Yeah. Just because it was, same thing, had cash on hand. And at the time, one of my buddies who is on the medical team that flew into Wuhan, China, he actually evacuated the U.S. consulate there.
Mm.
He was sending me videos, and he was in full med bio gear from the time they cracked the plane to evacuating those people. And this is a guy who's seen Ebola in Africa and done all that med stuff, and he was like, "Hey man, this is the worst thing I've ever seen here in Wuhan." So that's why, yeah, I wasn't comfortable jumping in March either. But hindsight's 2020, right? It could have easily had gone back up and then just rolled back over too.
Yeah.
But
Yeah.
it's just, I think even Mike Green talks about that. That was just the power, but that's the power of passive now, right?
Yeah.
Everyone just kept on buying it right back up.
Well, that's really the Mike Green point too, is passive never sold. So it was all the active managers who caused the dump. And so, I've learned so much since 2008, where when you're born in those environments, when I say born, like my financial journey was birthed in the GFC, right? So when that's part of your reality, you kind of always carry this bearish bias. And I feel like a lot of the people who were, christened in the last 20 years, maybe not last 20 years, but the last decade, they're going to have way more of a bullish bias. And so you wrestle with that a lot of times. And I definitely have learned over the last decade to not get married to narratives and these biases that we have. But it can go the other way, the same way. I think people have gotten too comfortable with the trade going one direction. And that's why I really feel like over the last year, particularly in terms of because of what happened in the markets in March and how it's bounced back and how everybody's a genius because of that, right? It's like the tide never really went out. But you know what? The one of the things I can appreciate more than I ever could before is the tide may never go out, and you need to change your approach to the game, right? And that's not necessarily meaning because everything is hunky-dory. It's just because various ways the markets are being managed or mismanaged, it doesn't unfold the way you think it should because of your philosophy or theologies or ideology on what is perfect markets and free markets. This is the reality, and this is the world that we live in. And I think especially since March, over the last year, I've gotten a greater appreciation with I've learned what I didn't know before, which is how many people have success in this business because they're honest with themselves and they know they don't know, which is really fascinating. Because if you're new to the financial world and if any part of your financial journey is on Twitter, good fucking luck, because everybody there is just smoke and mirrors pretending like they know everything. And for me, that was my Mensa. Like after the GFC, I got on Twitter and started building my community from various people like the Raoul Powells and whatnot, who I learned from in conversation. And so I got to be part of conversations or follow along with conversations that, absent of Twitter, I never would have been able to participate or learn from.
Yeah.
But you need to learn how to separate, the noise from signal on a lot of that. And there's just a lot of people that are selling snake oil. And so after such a chaotic economic event where you really thought, okay, the shifts are going to be right finally, and then they get crushed, and then Bitcoin's does 600% gains, and we're now in an alt season. And guys like the Mike Greens and the Jason Bucks and a lot of the people that I look up to and learn from, the biggest lesson I've learned from them is they'll be the first to say that they don't know shit. And that's in my opinion, it's such an empowering place to build an investment portfolio or investment theme from is this humbling place that like I can still make money and admit that I don't know what I'm doing.
100%. Because what it does is it lets you skip over the resentment, right? Like, I mean, was that insane that, the Fed is basically, sitting there, stacking jets and saying, hey, just drop, danger close, bring it all, unlimited liquidity.
Right.
Yeah, that was absolute insanity. I mean, that's what they were doing. I mean, it was just nuking it. And I mean, it's just like, oh, this is, how many trillions is it? 15, 20, who knows? We've lost count.
Yeah.
I mean, I literally tried to count it one day. I was sitting here doing research. I was like, okay, 5 trillion for us, 5 trillion for the ECB. And like eventually the T's just stopped mattering. It was just, what's one more T when you're at 15 or 20?
Yeah.
And, what's the long-term ramifications of that? I don't think any of us even know. I mean, it's just uncharted. It's uncharted territory. It's literally uncharted territory. We burn the maps and we're just sailing to the horizon. Where are we going? No one has any idea. And I think, and to your point, if you can say that and just try to have as much fun as you can along the way, hey, well, hopefully you can adapt on the fly, because that's essentially what we're doing now. You just got to adapt on the fly.
Yeah, the playing field has been leveled for all. Dude, Radigan, I mean, I feel like that's the exclamation point to end on, and I can't thank you enough for hanging out. It's been 4 hours, so I think that's
another 4-hour conversation. I love these. This was fun. I had a good time. Thanks.
Yeah, dude, I appreciate you, man. I mean, it's, living in a place like Hawaii, you don't really get to have these stimulating conversations, which is probably why I started building a community outside of that. And now where I'm traveling a lot and in different time zones, and certainly we're still somewhat in what feels like a COVID world. It's great to be able to have a 4-hour stimulating conversation with a guy I haven't met in person yet, and fill up that, fill up my tank a bit in terms of social interaction as well as intellectual stimulation. So I appreciate it, man. And I think you get feedback on this quite often, and I'll give you the same feedback. I think what you're doing is really cool. I think you've had a very unique journey in terms of how many people are sharing that unique journey. But I think there's a lot of people just like you who benefit greatly from the fact that you have the courage to write about it, to think about it out loud, and to articulate it the way you do. So I don't think you have any intention of slowing down or stopping, but I'm one more guy in your corner cheering you on.
Thanks, John. I appreciate that.
You got it, man.
Thanks for the links you sent me on what you wrote. I'm gonna read about that. I hadn't thought as much about real estate as you were into it, because that's your thing. So I'm actually glad you reached out, and I hope you don't mind if I have questions. I'm gonna reach out to you about.
Please do. Yeah, it'd be awesome.
Cool.
I'd love to help there. So yeah, man, let's keep in touch. And again, thanks for 4 hours of your life.
Hey, thank you. All right, have a good night.
You too, man.
Thank you for listening to the Money MBA Podcast with your host, Jonathan Kutsmeda.
It's also my pleasure to see to it that decent, hardworking people in this community aren't robbed blind by a pack of money-mad pirates.
To access more great content, visit us online at moneymba.com.
That's where the money is. And more than that, control.
There's only one person in the world to decide what I'm going to do, and that's me.
And I am deadly serious about that. That's it, I'm done.